Welcome everyone to our Tuesday videocast. Welcome everyone. My name is David Etienne. I know by now most of you know that name, David Etienne of Etienne Business Solutions. We are a public accounting practice, certified public accounting practice, and we have our regular Tuesday videocast. And so welcome this evening, and don't forget to also check out our YouTube channel, Etienne's Place, where we have a lot of videos for you, and all these Tuesday webcasts that we have been doing ought to be sitting on our platform, our YouTube channel, Etienne's Place. So check those out if you want a rerun, or if you missed, a particular Tuesday, or if you want to check out any other topics that we have dealt with in the past, which would range from business management, accounting, taxation, financial planning, you name it, it's all there. Okay, good. Let's jump right in. So for the past two weeks, we have been looking at this whole thing of IRS collection process. And today, I think, today would be the third segment, and I think the third and final. Today is the final segment, because we have reached to that point where we have gone through all the different correspondence. We see what they mean, we see the implications, and we're at that point now where you have even gone to the point where you have made your appeal, if you exercise that right, to appeal whatever the case is. And so your appeal has been addressed, and the outcome is here. And if you are very fortunate, then the outcome or the result of the appeal will be that all your tax debt is clean, has been zeroed out. Small chance of that happening, but it is possible. But the more likely outcome is either you find that you successfully get a revision, a downward revision, assuming some of your defenses are accepted, then it may have the effect of reducing the tax burden, the tax bill, and so you may end up having a smaller bill to pay. Or sometimes, all the things that you present as your defense or as your reasons for contesting the assessment, after a thorough review, the IRS may come up to say, yeah, we don't accept that, and therefore your tax debt, your tax balance, the amount you owe, remains as was determined from the outset. Good. So you're not at the point where you're faced with a bill that has to be paid. Let us say it's a bill of $5,000, $10,000. It has to be paid. If you're very liquid, if you can afford it, then yes, the best thing to do is to write a check to the IRS. Here's your money, goodbye. By doing that, not only would you have paid off your debt and clear your slate, but then you would not now be subject to any further interest or penalty, whatever, down the road. Just want to clear your debt, and that's it. Quite often, however, a taxpayer is not in a position to do that. And so you now want to see, okay, I'm accepting that, yes, I owe this $5,000 or $10,000. However, I am unable to just pay it like that, just to write a check and give to you, Mr. IRS. So what are the provisions in place? What are the accommodations in place for me in relation to this tax debt? And so this is where we hear the title or the heading or the phrase being bandied about, IRS Fresh Start. Everybody talking about IRS Fresh Start program, and people come and ask, what is this Fresh Start program? And some taxpayers even think that this Fresh Start program is a particular singular program, not realizing that no, the Fresh Start program is a set of accommodations. Let's put it that way. A set of plans and procedures and programs that the IRS has instituted that taxpayers owing money can basically utilize. So this Fresh Start program has a number of components to it, right? We're gonna quickly look at some of those. But the bottom line is that the Fresh Start program is exactly what it says. It gives the taxpayer an opportunity to a fresh start. Because you and I know, or I think you know that, debt burden can really cripple you. IRS debt burden, very crippling, and so you want to free up yourself. You want a fresh start, and so there are several things. Now, couple benefits or couple advantages that you derive immediately if and when you enter any of these fresh start programs are several of them. One, for example, is that, remember we said earlier on or last week that you'd have reached a point now where you have lien against your property, garnishment against wages, etc., kind of thing. Now, once you talk about having a fresh start program, then right away you start to get some of the benefits of this program. One of them being that you are now not subject to a lien anymore. So this fresh start program naturally prevents any lien being filed against you. So that's a biggie right away, okay? And even sometimes you find that at the time when you are contemplating the fresh start program or some component of it, maybe a lien was already filed against you. And so getting into the program or into one of the the elements of the program could effectively have that lien, although it was already filed, to be removed. It is possible. There's a possibility that can be done. And also remember that when you have an IRS debt of, say, $5,000, remember that debt has three components. There's the actual tax that you owe, there's an interest piece that has accumulated over time, and there's a penalty, okay? Penalty for not paying. So the figure you owe is made up of three components. Under this Fresh Start program, you may find that you are able to get rid of some or to avoid some of this interest penalty piece. So we talk about reduction, in penalties and interest, reduction in the penalties, and also the interest that may accrue on those. Okay. The other thing about the Fresh Start is that usually when you request of the IRS to give you some consideration towards addressing your tax debt in a manner that is going to ask the IRS to accept anything less than what is a total debt, usually the IRS will want to say, okay, I will consider it, but then I need quite a bit of information from you in order to make a determination. Now, this information is gathered on a form called a 433A. So it's a form number. 433A is usually what we call the information collection form, and that is usually when an individual is seeking some accommodation from the IRS that will hopefully for them result in them paying less than what they owe. So you have to give quite a bit of information to the IRS, financial information naturally, for them to determine whether or not they should consider giving you this leniency that you see. And so that information is collected via a form called a 433A. If you're a business seeking some leniency for your tax debt, then it will be a 433B. So 433A for individuals, 433B for businesses. But we're sticking to 433A for this evening. So that is a norm. That's a norm. However, under the Fresh Start program, you'd be surprised to know that usually you can be accepted under this program without having to divulge or without having to display or reveal all your financial data or data on that 433A. So those are some of the benefits that you derive once you talk about, getting into that Fresh Start program. That Fresh Start program. And remember I said earlier on that the program has several components or several elements. So again, you would have to see, all right, there are several options for taxpayers, but question number one, do I, as a taxpayer, qualify for the program? And what specific component would I qualify under? So like anything else, yes, there's the opportunity there. There's for you to benefit, but then there are always going to be some qualifiers or qualifying conditions, we call them, right? So usually we want to look to see, okay, all right, so okay, what do I do? How do I qualify? One of the good things you'd want to know is that under the Fresh Start program, there's no income requirement as far as qualification goes. Why is this important? It is because a lot of times for other things you find that if your income is above a certain level, then you're considered to be in a position to afford either an immediate payment or afford to make some arrangement to pay in a very short time. Okay? And so income tends to be a factor that factors into the equation. All of the Fresh Start initiatives, you find that income, in determining whether or not a taxpayer qualifies, income is not a consideration. Okay? So let us look at a couple of things that taxpayers would have to satisfy in order to qualify. First thing first, and I always say that to my clients or to potential clients that come about tax matters. I say, listen to me. The first thing we need to realize: the IRS will not entertain any discussion, any exchange, anything from you, any appeal, any request from you, if you do not have all your tax filings up to date. Yep. It's a given. That's the first thing, okay? You call the IRS and say, oh boy, I want to make an arrangement to do this, blah, blah, blah. Okay. They're going to say, okay, let me check your account. And so the first thing is that you must be current on all your tax filing. Of course, you owe some money to the IRS. You're coming to the IRS, to beg a pardon, so to speak, and yet you're coming with unfiled taxes. You're a repeat offender, so to speak. So you need to have all your taxes filed, your tax filings up to date. That's number one. No getting around that. Also, you have it was even lower maybe 2 or so years ago, but now your tax debt must not be greater than $50,000. You must not owe more than $50,000 to be able to qualify under the Fresh Start program. Now, this $50,000 is not just the tax debt. No, it is total debt, meaning that it is a tax, any interest, any penalty. Remember I said that usually your total sum owed has 3 components: the actual taxes owed, the interest that is accrued, and whatever element of penalty that is attached to it. So those 3 together must not exceed $50,000 for you to qualify under this Fresh Start initiative. Okay. Also, the IRS has a requirement that any payment arrangement can extend up to and no more than 72 months, 6 years. And of course, you may say that is quite a while. Yeah, it is a reasonable length of time. Okay, so the IRS will allow you up to 6 years, which is 72 months, over which to repay your tax debt. So when you get into this program and the arrangement to pay and how long will you need to make these payments, you can go anywhere between 0 time, meaning that you're going to write a check right away so you don't need a plan, or up to 6 years, down the road, which is 72 months. All right, so that is critical. That's critical to know. The other thing too is that sometimes, based on your circumstances, like if you're an independent contractor or for whatever other reasons, you may have a requirement. There may be a requirement for you to pay what is known as estimated taxes. Okay? Estimated taxes. So usually people pay estimated taxes on a quarterly basis. Usually do a 4 quarterly payments for the year. And so there are certain time deadline for each quarter when the payments are to be made. If you're such a person who is required to make estimated tax payments, then again, that's another thing. You have to be, you have had to be obedient and prove that yes, I have been making those required estimated tax payments. Okay? And another thing is that another thing very important about the qualifiers. Oh yes, right. You must not be involved in a tax evasion scheme. Yeah, naturally, okay. So therefore, there must not be evidence that you're trying to somehow evade paying taxes. Some tax fraud thing. You're falsifying documents to prevent the IRS from realizing or to avoid paying over the taxes. All those are natural things, right? Because there's no way the IRS is going to accommodate, let's be frank, a criminal, because it would be a crime for you to be doing that. So those are some of the things, very important things that you need to keep in mind if you reach to that point where you're contemplating whether or not you would benefit on the Fresh Start program. Okay, so those are some of the things that definitely that you have to consider. Good. Now, under the Fresh Start program, there are several, under the Fresh Start initiative, let me call it that, okay? Under the Fresh Start initiative, there are several different programs. And so you need to know, okay, what do I qualify for? The simplest and most basic is that the IRS is saying, okay, if you don't have any money, if you don't have money to pay the bill right away, we can make some arrangement through a payment plan. And I think the payment plan is what most individuals who have to contend with this sort of stuff would be aware of. Payment plan. And a payment plan with IRS is a payment plan like any other payment plan. You can't pay your bill at one go. You're going to make an arrangement to pay it over time. And so you talk about payment plan. Okay? Now, bear in mind, again, like any other payment plan, since you are paying over time, yes, you're paying to reduce what you owe, but you will continue to have a balance owed at the end of each month, a balance owed at the end of each quarter, a balance owed at the end of each year, because you're paying down a bill. So there will always be a balance owed at different points in time. Good. Bear in mind that although you're under this payment plan, the balance that is owed will still attract interest. Yep. It's just like if you had gone to the bank, borrowed some money, and you are given 5 years to pay back the money. Well, you will realize that if you're given a loan and you give what is called an amortization schedule, which is basically that table that show how much you're going to pay each month, and the amount that you pay is broken down between the principal and interest. All right, and it shows you as the balance of the loan reduces, then you find that the interest figure gets less. So it starts with a very high figure. So most of the payment you make goes to interest. Little bit goes towards paying back the principal, the loan. But as time goes by and the balance gets lower and lower and lower, then the interest, although it still applies, is now calculated on a lower balance, lower loan balance, and therefore the interest piece gets less and less and less. So back to the IRS is that yes, you have a payment plan, but hey, you still owe money, and so you're going to find that interest and thing is still going there. So what you find sometimes is that a person may say, all right, the IRS allows me up to 6 years, 72 months to repay this debt. And they decide, okay, I'm just going to go for that maximum time. And so they go for the 72 months because, of course, the 72 months, give them longer time to pay. The monthly payments are so much smaller than if they had gone for, say, 36 months, 24 months. So they go for that. And so they're making these payments. Not recognizing or realizing that when you have such an arrangement, then, and I'm just going to theorize now, if you pay $100 per month, you'd be surprised to know that most of that $100, it all depends on what is the balance that you owed, which will determine the amount of interest as is calculated on it per period. What I'm saying is it's possible that most of that $70, $80 of that payment of $100 could end up being just interest penalty being paid in the earlier years, in the earlier months and years, okay? And the portion is going towards actually paying down that debt is so small, so you have to be very careful. Sometimes people say, man, I've been paying and paying and paying, and it seems as if the balance is not going down. Oh yeah, because you see, the interest and penalty is actually sucking away most of your monthly payments, and so that is something that you definitely need to keep in mind. Now, under the payment plan option, as I said, it's a plan to pay over time. You can actually have what we call two different, like a streamlined, like a streamlined payment plan, as opposed to a partial payment plan. Streamline, as this thing says, just what I described earlier on, you decide, okay, I'm going to pay it over 36 months, 48 months, 72 months, and so the total debt is divided by those number of months, and I decide how much I'm going to pay each month, and it's streamlined, and I know exactly what's going to be happening. But I have arranged to pay the full debt over that period of time. On the other hand, we may have what we call a partial pay, partial. So we say, okay, we make an arrangement where we're saying, okay, here's what's going to happen now. With that now is that, and that that can be very ill-advised. Because see, under that arrangement, all your required, and of course those payments will be smaller, because what will happen is that all you're going to be paying is just like a payment on the principal. So like a payment on the principal. So while that is happening, you find that the interest and the penalty is accruing. The interest and the penalty is accruing. And so this is not similar to, but you can, if you're aware, if you know what balloon payment in terms of a mortgage is concerned, that kind of comparison, where with that arrangement you actually make interest only payments over time, not paying any principal, and then when that time comes, you have the total debt that becomes due to be paid. So over the years, you have just been paying interest and interest and interest. The principal has just sat there, and then come that time, whenever it was 5, 6, 7, 10 years on the road, then the time comes for you to pay, and then you have this big debt. We could actually liken it to that, where you're now here making small payments to the IRS because it's a partial pay arrangement, and then you find that the interest and penalty keeps accruing and accruing and accruing. Okay, so that's another thing. So yes, the provision for payment plan is there, and most persons will need to avail themselves of this facility. But as I said earlier on, that the best thing with any debt is if you can just pay it, get rid of it, then hip hip hooray. Hip hip hooray. Okay? Now, there's what we call like a short-term payment plan, and a long-term payment plan. Short-term payment plan, long-term payment plan. And so usually, with the short-term payment plan, they usually say the devil is in the details, you know that term. But for now, the thing about the short-term payment plan is that you must owe less than $100,000 or so. And again, when I quote those figures, it is a total. The total that you owe, which is tax, interest, penalty, must not be more than. So in this case, when it comes to a short-term payment plan, we talk about $100,000. And if it's a long-term payment plan, then the limitation is that you must not owe more than about 50,000, which is everything. Okay, good. Now we can talk about payment plan, or we can go to other areas. Let's take for example that you're saying, all right, yes, I see that I owe $25,000, but hey, the truth is that I don't see how I would ever be able to pay this $25,000. So I want to enter into some compromise. That's what it is, some compromise. I'm seeking a compromise. What does that mean? All it means is that, yes, I know and I accept that I owe $30,000, but I will not be able to pay $30,000, and so I'm seeking to see what we can agree on, what lesser figure we can agree on as full settlement of the debt. Now, very important point here to note, when you approach IRS to say, okay, yes, I know I owe this, but I'm seeking, and it's really called an offer in compromise. I'm seeking to make an offer because I'm seeking a compromise. Note two things. One, you could be doing this or making this application on the basis that you're saying, yes, I owe this $30,000, but I am unable to pay this $30,000. That's one. Or on the other hand, you could be saying, yes, I owe the $30,000. Yes, I can pay the $30,000. But if required to make this $30,000 payment, it will cause me undue hardship. Hardship. Okay? So mark. One is I cannot. One is, yes, I could try my best and come up with the money, but it's going to cause me terrible economic, financial hardship. And so on either of those bases, you're saying to the IRS, I need to have a compromise. And so we talk about offer in compromise. Okay? That in itself is its own beast, meaning the qualifiers are there. Now, earlier on, I mentioned this Form 433A, which is the information gathering form. Now, once you talk about offering compromise, then yes, remember now, you owe the IRS $30,000. You may be saying to the IRS, I wonder if you think taking $6,000 as full settlement of my $30,000 debt, because either I cannot pay any more than $6,000, or if I am asked to pay more than $6,000, it's going to cause me undue hardship. The IRS will say, and when I say the IRS will say, the IRS will speak to you through this Form 433A, which is saying, okay, give me all this information. So if you take a look at your 433A form, you will see that it's a very comprehensive and, I like to call, intrusive form. Okay? Meaning that it really asks for all your financial information. Bank account, house information, car, mortgage accounts, credit cards, insurance policies, all these things ask about. Your income, how much money you earn, your monthly household expenses, you name it. Basically, the IRS is saying, for me to consider an offer in compromise, which is me considering accepting a much lesser figure as full payment of your bill, then I need to be satisfied that you really cannot afford to pay. How would the IRS know? No other way but to get all your financial information. All your financial information. Okay? Cool. So, I usually say to clients who are thinking of going for an offer in compromise, listen up. There is an IRS tool And even outside of that tool, there are some simple steps that you can take to predetermine the likelihood that you will be accepted for an offer in compromise. You need to first explore, look at those, use this tool or go through this simple little review to determine whether or not it makes sense. Because hear me now. You do not want to just put all your financial information on this 433 form and send it into the IRS, your bank account number, routing number, bank balance, insurance, whatever, house, car, okay? Only for the IRS to come up and say, oh no, based on the information you have given me, you can more than afford it, so don't even consider that. We're not even thinking about offering compromise for you. And so you'd have, bare your soul, your financial soul to the IRS and, reveal everything. I'm not trying to say that they're going to use and do anything nefarious, but all I'm saying is that, hey, if you do not have to, why do that? So I would say, kind of do that little pre-evaluation to know whether or not you have a reasonable probability, if there's such a thing, a reasonable chance of being accepted. Okay, good. So that 433A form is really a very comprehensive thing. It looks at ballpark, it looks at two things at the end of the day. One, it looks at what they call your your disposable income. What it means is that after you have received your income, your salary, and you take care of all your living expenses, etc., medical, you name it, then how much money would you have left over each month? Okay? That's the excess income. After you take the income, take all your expenses, home, this, etc., how much do you have left? That's on the one hand. It also looks at your asset position. So that's why it looks at your home, your car, insurance policies, investment accounts, all these things that you have. And of course, it will look also at the debts that you have, any car loan outstanding, any other loan, kind of thing. And it balances your assets, which is a stock of value that you have, against your liabilities, which is the stock of indebtedness that you have and obligations. And so it sees, okay, which is heavier. And so if the asset total is bigger than the liability obligations total, then you have a positive net asset, so to speak. And so with a positive net asset and disposable income or residual income, then you may find that the two together is such that the IRS is saying, nah, you're able to afford this. Even if you can't pay it right away, you're able to afford to go on a payment plan. We're not giving you an offer in compromise. So again, these are things that we wish to consider very carefully. I think. Good. Again, there's a lot of details to offer in compromise, and if that is something that you're interested in and need to go there, then yes, you'd have to have a specific sit-down consultation on that matter. Okay. Moving right along, now there are times when, by virtue of your financial circumstances, you may find that your account can go into what we call non-collectible status. Non-collectible, meaning that you owe the debt, you continue to owe the debt. Yeah, the debt is not removed, it's not wiped away, but right now, you just cannot. Your financial circumstances does not allow you or afford you the opportunity or the ability to make any payment. And so it is the IRS freeze the account, freeze that debt, and say it is there on the books, it will not go away. Anybody who is making any search as to your credit worthiness or your the kind of debt that you have outstanding, they will see that debt sitting there. It is just that it's in a non-collectible status. Now, for you to qualify for that status, then, of course, you would have to, again, give a lot of information for the IRS to prove that position. Also, you can find that you can get a little leeway under what we call the hardship status. So we have a non-collectible status, then we have the hardship status, right? And of course, if you can't pay your taxes, okay, you can say, okay, boy, I'm claiming whatever under the hardship status. And what it is saying is that once you're under the hardship status, then the IRS will not collect on your debt until your financial condition has improved. Okay, until this hardship is is abated, so to speak, so that things are better with you and so good. Now, what does it mean? If you are in non-collectible status or hardship status, your account is sitting there. So note, don't think then you can go and live lavishly and earn a lot of money and buy this and buy that and etc. and still continue to remain in hardship status or non-collectible status. Now, because the IRS will definitely be monitoring your financial life to determine whether or not you continue to be in the non-collectible hardship category, or if things have improved and so you are now able to, in which case they will take your account out of non-collectible hardship status and say, hey brother man, it's time to get back on the payment train. Okay, cool. So that's about it for today, and I think this basically wraps up our little 3-part series on IRS collection process. We have really skirted over most of the thing, but I just want to give you a general overview of how the thing runs. You see, so that you're not just running up and down, panicking and tearing out your hair and that kind of thing. You have an understanding, a basic understanding of the process, the correspondence, what they mean, what's the implication of the correspondence, and therefore what course of action you need to take now, what course of action you can delay taking, what are your options, and if it comes to the end of the road where yes, you're stuck with a tax bill, then what are the accommodations and the programs that the IRS has to facilitate taxpayers who are unable to pay, like that. So that's my bit. So David here saying, hope you got quite a bit from our 3-part series, and we'll be back here next Tuesday. Of course, not yet decided as to what we will be talking on, but you'll be advised in short time. What I find is that, yes, I say it over and over, sometimes I'm interacting with clients, or I get a call, somebody called me about something, and questions, need some clarification, and sometimes I even get a call from more than one person on the same subject matter, and they say, maybe that's something that I would speak on, because obviously it is a matter of interest to a few that I'm aware of, and so hey, it may just benefit quite others. So that's it. But until then, until next Tuesday, this is David saying bye. Remember now, check out my YouTube channel, Etienne's Place. Like, subscribe, hit the notification button so that you will be alerted to our new stuff. Did I say share? Did I say subscribe? Did I say like? Did I say leave a comment? And I will definitely see what it is that is of interest to you. And if there's an area that you would like us to explore, mention it and we'll get on with it. So bye for now. Have a wonderful rest of the week. Work hard, work smart, make a lot of money, be profitable, but most of all, God bless. Okay, until next Tuesday, I'll see you around.